Hi, it's Aoife and David, and welcome to this week's Markets Happy Hour podcast. I'm delighted to be joined here by Alan Dunne, who is the founder and lead at Archive Capital. Welcome, Alan. Great to see you there from joining us from Dublin.
Thanks, Stephen. Great to be on. Great to see you.
Well, we've got a lot to discuss this week. We'll start with geopolitics, and we're going to move to your regime adaptive portfolio discussion. So, with no further ado, let me pull up the slides. Well, I've called this podcast Regime Change and Regime Adaptive Portfolios. The Regime Adaptive Portfolio is a nod to a recent white paper that Alan wrote. And regime change, of course, is on everyone's mind. And we last recorded this podcast on the 1st of the year. We're now coming to you barely a week later. And over the weekend and in the interim, we've had tremendous amount of geopolitical developments. It has not necessarily had a strong impact on markets, but we've obviously had the capture of President Maduro in Venezuela and the aftermath of that, and a lot of debate around whether this is a precursor to regime change there. I did put a nod to Venezuela in the cover here with the beautiful Angel Falls on that picture. As usual, we'll cycle through the main topics of inflation, interest rates, equity markets, geopolitics, and other asset classes. We'll have more of an emphasis on geopolitics and regime change this week for obvious reasons. And in terms of some of the sub-themes, we'll ask whether this is a brave new world we're in terms of geopolitical alliances and what that means for asset classes and for the world order. We will again return to the theme of volatility as a feature and not a bug, perhaps in 2026, looking at some of the concentration in equity markets and some of the volatility that could come from that. We've spoken before about 2025 being a defining year for metals, and we will ask, where do metals go from here? I think Venezuela is not irrelevant to the metals picture. And then be focusing on Alan's regime adaptive portfolios. The theme of last week of New Year, New Nihilism, I think has been very much eclipsed by geopolitical developments. So we won't go into too much detail on that. So here's Alan. And again, thanks for joining us, Alan. So Archive Capital is based in Dublin, and we've got your bio here. But I think the key thing to point out is just the range of experience you've had across asset classes as an allocator, a macro strategist, and as a technical analyst. So we're looking forward to translating some of that into our views on the topics today. So as I said before, this has been really a week where geopolitics have dominated. But if we look to what has happened in terms of pricing, hasn't been much in the way of inflation data, but we can see that the initial reaction to the events in Venezuela by oil has been somewhat minimal. We do know that demand supply affect oil, obviously, and the promise of the Venezuelan intervention has been more supply. So that would drive prices down and would ultimately be conducive to keeping inflation in check. But I'd love to ask you, Alan, in terms of your views for inflation, does this change? Where have you been coming at in terms of your inflation forecasts for 2026? Does this change anything? Do you think we're heading into higher than expected inflation, deflation? What were your views?
Good question. I think in the short term, this doesn't change a whole lot. It was a very dramatic action, obviously. And, coming into this week, I think the knee-jerk assumption was we were going to see lower oil prices. Oil prices have been choppy, but net haven't done a whole lot. And I think the reality is, the realization is really to tap into those huge reserves in Venezuela. It's going to take huge investment. That's a multi-year, maybe multi-decade project. And we're already hearing reports of Trump meeting with oil leaders in the White House tomorrow and the demands that they will have in terms of financial and security guarantees before they commit any significant dollars to development in Venezuela. So I think it's definitely a significant development from a geopolitical perspective. I don't see it changing the inflationary dynamic or oil prices in the short term. Inflation this year, I don't do a forecast. We're very much focused on the kind of the multi-year time horizon, and our base case is, inflation is stickier than it's been in the past. It may come down a little bit, but kind of 2% be more of a floor than a cap is our overall philosophy on inflation.
Very interesting, because I listened to a webcast yesterday, which was developing a little bit more the China deflation story, suggesting that China would export deflation to the rest of the world. it was almost like Japan 2.0, given that Japan was dealing with that for decades.
Yeah.
And we also, I think, prior to the COVID-induced inflation, we did have a bit of this Cathy Wood narrative around deflationary pulses driving prices down more generally.
Yeah.
So, but you seems like you're hovering on the inflation being a bit stickier, higher than maybe the 2%. Is that your base case at the moment?
Yeah, I mean, I think what you say about China is fair, but you also have to accept like which countries are willing to accept that deflation. Obviously, what we've seen with tariffs in the US is an unwillingness to accept that deflationary impulse from China. Similarly, in Europe, obviously, we've seen an influx of EVs here. BYD has probably been more of a household name than it was in the past, but at the same time, Europe has slapped on tariffs, and this Chinese policy of you know, um, exporting its excess capacity to the rest of the world is being met with pushback. So there is that question about the willingness of the rest of the world to absorb that China surplus and that disinflationary impulse. So yeah, looking at a lot of the other factors like more constrained supply, obviously the tariffs, but also factors like demographics, reduced labor force participation, less desire for immigration. All of those are more inflationary aspects in the developed world in terms of labor markets. So, yeah, certainly still see. Plus, the fiscal impulse in terms of defense spending, a desire to provide fiscal supports on any type of affordability issues. All of that means more spending, and I see that as being more inflationary.
Very interesting. And also just in terms of where metals are going, the met copper does tend to trace the expectations of economic growth. And this chart will show that it's setting a series of record highs. We know that the other metals charts look
Yeah.
very similar. And certainly with the demand for some of the critical minerals as well, we see pricing there being driven higher. So that would all be supportive of that thesis. Moving now to the flip side of inflation and interest rates, and the news, this was that in the last week that we've seen on around interest rates has really just been a parsing of the Fed minutes and revealing the divide there and how data dependent they are, but not exactly consensus in terms of the next cut being downwards, although we do know the incoming chairman is likely to be so inclined. But what's your take on the interest rate direction from here? And we started with the US here, but I'd be happy to hear your views on that more central banks globally.
Yeah. Well, I think it's interesting. What you're hearing from the Fed is that rates are now in the area, in the region of neutral. So it comes back to that classic question, what is neutral? And we never know in real time what it is. We might know years or decades after. But around 3.6% is probably the upper range. The Fed probably thinks neutral is maybe three or so, but it could conceivably be higher. So I think from that perspective, there is a good reason for the Fed to pause here. Obviously, we've had a lot of disruption with the economic data as well, and we have had some numbers out, but they have been distorted. So for all of those reasons, I think it's likely we're going to see the Fed on hold for the next few meetings. Even a few of the people who voted for cuts were saying that they could see reasons for not cutting at the last meeting and holding off. So I think given that we've already seen, with 1% last year, the year before, 0.75% last year. We've come a decent amount off the high and we're into that range of neutral. So I think from a Fed perspective, there is uncertainty. Obviously, there's downside risks to economic growth. We're still waiting to see the full impacts of the tariffs. The general sense may be that the impact on goods might become more muted over time, but there's uncertainty around that. So I would still say, rates on hold. We probably talk about the K-shaped economy as we go along, but we're still seeing that huge wealth impulse from the stock market. I mean, that can't be ignored. And elsewhere, like in Europe, I saw Isabel Schnabel speaking in December. She was very upbeat on, or more upbeat on the outlook. And my read listening to her was the risks, if anything, to inflation and rates in Europe were to the upside.
And certainly I did see that the ECB's next move might be up, that
Yeah.
they there was a sort of a confidence creeping into some of their statements, which is great to hear. Some of that may be driven by defense spending. Some of certainly the backstop of having had a strong equity market within Europe, but also bolsters confidence. So it's very interesting to see just where we are falling out when it comes to that. moving now to equity markets. So the story of the year has certainly been the US equity market resilience. Although interestingly, and we showed some charts of this last week, it was actually the Asian markets that dominated in terms of actual performance, and some individual markets, whether it be Spain or Peru, really shot the lights out in terms of very strong double-digit performance. I'd say the other observation at the end of the year, and this I'm sure you've seen this yourself, has been just how great expectations are, in the sense that it was hard to find any bearish outlook for 2026. All the recession prognosticators seem to have disappeared into the distance, and it was a universally positive set of forecasts and outlooks. Clearly, we also had quite a strong start to the year, even though we've had this geopolitical upset. Would you think that this is slightly disturbing to see no or very few naysayers in terms of the positive outlook for 26 in markets? Do you think that there's exuberance taking over?
I mean, certainly there is exuberance, of some degree. As you say, last year we had a lot of concern and the market climbed on the wall of worry. What you tend to see at the peak is obviously higher multiples, higher margins, everything gets extrapolated higher. So it's definitely a concern. But, I think a recurring kind of phenomenon discussion in markets has been this parallel between the mid to late 1990s and what we're in now. And, the question is it closer to 1995 or 1999? And I mean, that is the question. Tough to say. I mean, obviously valuations are high, but on a one-year time horizons, valuations don't really act as a very strong signal. So yeah, I think it is worrying. It creates something of a dilemma, I think, for investors, that desire to stay invested in the markets, but still construct portfolios and have exposure to assets and strategies that can help build resilience if we do turn down. So I think that's really the key takeaway. Very hard to stand in the way of the market and the momentum, but at the same time, you need to have one eye in terms of, well, what diversifiers have you got in your portfolio? And then we'll get into that in a lot more detail in a little bit.
Absolutely. Well, I think it's interesting here on this chart has been now the focus on whether we're going to have the fourth straight year of gains, and this next chart just show that the last 3 years have been positive. And looking
Yeah.
back, we've seen 5 years of gains, not phenomenal gains, but there does tend to be a little bit of a breather taken after we've had those. Again, you referenced 95 and 99, and of course back in 95 there were another 4 years left to go. And then 99, we all know what happened then in the first sort of dot-com era correction. And when it comes to PE ratios, the S&P 500 come off slightly, but still averaging pretty high relative to its history. But then there's been that narrative, and one wonders if it's a reaching that we're seeing by journalists and headline writers to find the contrarian voice. They
Mm.
have identified one or two pension funds, superannuation funds, or fund managers who are maybe downsizing their US tech exposure, broadening their exposures, maybe expecting some kind of a pullback, some kind of a reckoning. Does anything seem alarmingly jarring to you, or out of sync in terms of whether it's sector concentrations or some of this momentum?
Well, no, I mean, I think from a valuation perspective, if you look at the data, I mean, the valuations that we're realizing at the moment have generally been consistent with below average returns on a kind of a 10-year horizon. So if you have this kind of starting point, a reasonable expectation would be, certainly below average returns for the next kind of 5 to 10 years. But the question is always, is that going to be in the next 1 year, the next 6 months, or is it going to be somewhere down the line? So I think that's the challenge. I mentioned the K-shaped economy already, the wealth effect, and the reality is, there's a tendency to look externally and say, okay, what's going to be the trigger for the market? Is the economy going to be good? Is it going to be bad? How is that going to drive the market? But you have to flip it around sometimes and recognize the market is driving the economy. It's a reflexive process. Anybody looking at their 401k is going to be saying, wow, I'm up another 20% this year. That gives a warm, fuzzy feeling. If you look in your personal portfolio and you see that kind of gain, there's a temptation to monetize that and spend some of those gains. So I think that is a real dynamic. Rising values create a wealth effect. You tend to have lower volatility, collateral values go up. It tends to be reinforcing. So the question is, what changes all of that? I think until we get to a point where we get a radical reassessment of the earnings trajectory, that trend is intact. I'm not saying I'd add or aggressively allocate here, but I think you have to stay invested and, as I say, construct your portfolio with one eye on the downside, but hard to fade the market.
Fascinating. There's so many things we could discuss here, and I am going to move now to talk about regime adapted portfolios. But just one thing to just clarify when we're speaking about this divorce, I think it is between Main Street and Wall Street, or how they're kind of they're realigning in some way. And you mentioned that wealth effect. And when I did a podcast in Dublin, a live podcast, some of the Irish participants there pointed out that that wealth effect may be certainly more obvious in the US, where retail participation in the stock market is a lot more dominant and I suppose more significant. That in Ireland or throughout Europe, there may not be the same participation by the average retail investor in the
Yeah.
stock market. So they're not really capturing that wealth effect to the same degree. Do you observe that from your vantage point?
I think that's fair to say, yes. I mean, there's certainly not the same investing culture in Ireland or continental Europe as there is in Europe. I think it is growing. There's a rising level of interest, but it hasn't been there historically. There's not that culture. There's not that, the tax regime isn't as accommodative for personal investing, at least here in Ireland, I can say for sure. But so certainly, traditionally people's wealth was more tied to property over here. But anybody who's a business owner would benefit from rising asset values. And we've certainly seen rising wealth levels in Ireland, and we've seen more and more business owners being successfully exiting business, and all of that benefits from rising equity markets. So I'd say, yeah, at a retail level, certainly not the same, but I would say it's not something that Ireland has been immune from at all.
And now I'll move to the regime adaptive portfolios. And I suppose this is, I get it, the four words that come to mind when I think about regimes and regime change is it's different this time.
Yeah,
And you've spoken about the importance of classifying assets by behavior and how it's done.
yeah.
And as I ask you what this is, I'd love you to comment on whether it is different this time. Are bonds and equities behaving differently? Are developed and emerging markets behaving differently? So I'd love to turn it over to you and explain a little bit what is a regime adaptive portfolio.
Sure. Well, I guess, firstly, the expression regime, because you say regime to a non-market person and they're thinking, oh, what are you talking about? Is it like military regimes or what? And we, us in the markets, we assume what people understand by a macro regime. But, just to be clear, it's the kind of the dominant economic and market conditions that prevail over years and maybe even decades. So, I mean, the obvious one is the disinflationary regime that we had effectively from 1980 to 2020, I would say. It was the era of falling inflation, globalization, central bank independence, moderate debt. And what did we get from that? It was a great era for financial assets. The starting point was really favorable. Volcker brought rates to 15 to 20% in 1980. So that pushed up bond yields, pushed down equity valuations. So it was a great starting point for financial assets. And then as inflation came down, as interest rates came down, that was a boon for financial assets. After the financial crisis, we had quantitative easing, so we had actual asset purchases from central banks, and that pushed the regime and this kind of disinflationary and falling rates regime even further, culminating in, it's not so long ago we were talking about the trillions of dollars of negative yielding debt, and this was a huge problem for the global economy. And what you get with every regime is the regime sows the seeds of its own destruction. And that was the negative yielding debt, basically encouraged policymakers to take on more spending. So again, 5 years ago, around the time of COVID, modern monetary theory came to prominence. The challenge for central banks was how could they raise inflation? That was the big dilemma in Europe. Inflation was sub 1%. Even for the Fed, how could they get inflation up to 2%? So the idea of flexible average inflation targeting came in. So what we've had since then is this regime shift that's been driven by a number of factors. Obviously, I think there's been two big events, COVID and the war in Ukraine. That basically propelled the global economy out of secular stagnation into a higher nominal GDP trajectory. We went from abundant supply to more constrained supply, globalization in reverse. We've got, I suppose, resiliency of supply chains instead of the efficiency of supply chains. And we've had an enormous fiscal impulse which has resulted now in higher debt levels, and higher deficits have become the norm. And that's created concerns over public debt. And I think from a market perspective, the obvious implication, and from a portfolio construction perspective, has been this shift into bond equity correlation. So what we saw in the 2000s to 2010s, a very consistent negative correlation between bonds and equities, which was a function of the disinflationary era because central bankers could aggressively ease on any type of downturn because they knew inflation wasn't a huge problem. That's no longer the case. And that came home to roost in 2022 when we saw bonds and equities declining at the same time. Now, some people might have said that was a one-off. Bonds were rising from a very low level. But if you believe in those structural changes, there's nothing to say that we can't see further episodes of these inflation spikes and further periods where bonds and equities could fall at the same time.
And I put up here on the slide for anyone watching the YouTube just the rubric that you have suggested there in terms of thinking about the disinflationary era and the new
Yeah.
macro regime. And I suppose then that the classic investor or client question might be, well, so what? Okay,
Yes.
so things are starting to the correlations are different. And on the other hand, other asset classes, perhaps like gold, are not behaving as they have. They've had a kind of stunning run.
Yeah.
On the one hand, that maybe indicates the frailty of some of this fiscal situation you mentioned, the lack of trust, a shift away from the dollar. But equally, it's they're moving in sync with other risk assets. So how do clients build a regime adaptive portfolio then, or a resilient portfolio?
Yeah. So I think it's important to keep in mind, specifically with the 60/40 portfolio, it's a financial asset portfolio. That's the first thing. It's 60/40, but equity risk tends to dominate. Equities are more volatile than bonds. So if you think about that shifting environment, particularly in relation to debt and in relation to the bond equity correlation, obviously the big risk is that you get a significant equity downturn for, obviously we've talked about the high equity valuations. There's uncertainty about the economic outlook. It's very hard to say we're going to see a correction now, but it could be at some point in the next few years, and reasonable to expect lower equity returns going forward. So even if bonds perform well, a 60/40 will probably be challenged because the lower volatility of bonds. But a worst case scenario is that you actually see concurrent declines in bonds and equities from recurrent inflation spikes. I think they're the two obvious things. But I think more fundamentally, what we have to think about with this change regime is more the tail risks, and that it's not just about volatility. I think you mentioned volatility at the start, and volatility is a feature, not a bug. It's uncertainty as well as volatility. And what's the difference? I mean, volatility is nearly everything you can quantify and categorize, but uncertainty are all the unknown unknowns that can come along. And we've had, more and more of those in the last number of years. And I think one of the other features of the changed macro regime is what we're seeing at the moment in terms of geopolitics, a shift in the institutional norms, a shift in the typical international political behaviors. Where does that play out? Who knows? A shift in the norms with respect to central bank independence. Central bank independence and anchoring inflation expectations was one of the big successes of the disinflationary era, but it seems we're very happy to throw that out willy-nilly without any concern of what that might mean. The 70s was in an era where inflation became embedded. Now we've had an inflation spike, but we haven't had a decade of it. If you get a decade of higher inflation, that's when it becomes really embedded in the psychology. So I think it's those tail outcomes that are also more concerning. It could be much higher inflation. If you get much higher inflation, then you may get episodic asset deflations within that. So that would all point to a much more volatile and a much more concerning macro environment.
For some investors, the answer to all of that may just be diversify.
Yes.
Because there's ultimately, we know that there are more correlations perhaps in certain aspects of the portfolio, and
Yeah.
certainly it's safe to say that uncertainty is perhaps more prevalent now than ever before, especially with unorthodox foreign policy, and equally, I would say new asset classes emerging, and equally some of the suggestion that the economy has become immune to some of that. They're immune
Yeah.
to some of the geopolitical developments. I've used the term anti-fragile to borrow from Nassim Taleb in terms of some of the just that ongoing the fact that the market has been broken time and time again and continues to rebound. And
Yeah.
previous guests have talked about private credit. We've been poking around looking for weakness in private credit with the cockroach here, a cockroach there.
Mm.
But ironically, some people are interpreting the resilience of that market as being a sign, well, their weakness cannot break it. It cannot be contagious. The banks are strong enough; they can weather the storm.
Yeah.
So, arguably that there's that dynamic as well. Would there be any single solution to ride out this uncertainty and insulate a portfolio, or is it just a variation on the diversification theme?
Yeah, I think diversification is a really important topic because this is where, a lot of people come a cropper really. And I mean, that was the motivation for writing this paper. And certainly one of the big themes of it is that you can look at a portfolio and even sophisticated institutions, they may have exposures to, 10, 12 different asset labels, equity, private credit, real estate, venture capital, investment grade bonds, high yield, emerging market debt, etc. But actually, when you put a really critical lens on it and ask, well, what are the underlying drivers of these exposures? The tilt towards growth and low inflation is enormous in most portfolios. You talk about private credit, and because you put the label private on it, does that mean it's a diversifier? It's alternative, yes, but is it a diversifier? It's still the type of asset that has a big negative tail. It's what we would say in the industry. In maybe 80 to 90% of the scenarios, it performs fine. But how does it perform in that negative 10% of the distribution? So there is this idea of the myth of diversification, particularly with assets like credit, they can be lowly correlated with equities in a bull market, but in a bear market become much more positively correlated, which is exactly what you don't want. You want assets and strategies that can be negatively correlated with equities in a bear market. So there is this sense of, okay, I'll diversify into a lot of asset classes, and that gives comfort that I've got a very diversified portfolio. But you have to look into that portfolio and say, well, what are the inherent factor exposures? Is it very much tilted towards economic growth? Is it very much tilted to a disinflationary or a low inflation or a stable inflation regime? And if it is, well, then the question is, what types of strategies can genuinely add more diversification? Obviously, my background is in hedge funds, trading strategies, and so obviously, biased is one way of viewing it, but certainly a big advocate for the benefits, the diversification benefits you get when you add strategies like trading strategies, whether it's quantitative trading, trend following, or discretionary trading like global macro, or even volatility trading. But these are what I would call adaptive strategies that can take positions and adapt to different environments depending on how those environments are playing out. And that brings an element of adaptiveness to portfolios where if you construct portfolios purely on the basis of historic relationships, then what happens when those relationships change in a new macro regime?
Well, I don't think we're going to give that argument full justice here, but I think it is a very important, I think, as a reminder not to slip into complacency when it comes to expecting asset classes to behave as they always have. And
Yeah.
just to wind up and I think that there's an interesting slide here for those watching on video, comparing the CAPE with the US debt to GDP by decade. I think focusing on the fact that we are in a decade where we have this that US debt to GDP how would you describe this chart here, and what is the key takeaway from that?
Yeah, what this is telling me, we're in an unusually, I suppose, fragile macro backdrop. If you think about it, we've had higher equity valuations before. We've had high debt levels before after World War II. The US economy was able to grow out of it. But in this period, we've never seen this concurrence of high debt and high equity valuations. Now, they're not two variables that are often plotted together. So you might say, well, what's the significance? What's the implication? Well, the implication is if we got a significant downturn in the equity market, which would not be a shock given the high level of equity valuations, what does that do to the economy? Well, obviously, given the increased financialization of the economy, which we've been talking about, US households owning $40 trillion of US equities, you could have a very meaningful hit to the economy. And what's the natural response to that? Well, the natural response is higher deficits, more spending, the fiscal multipliers kick in. Basically, every time we've had a recession in the US economy, the debt GDP level has ratcheted higher. And the point is, well, could that be the point that pushes us into fiscal dominance? And is that the possible straw that breaks the camel's back? Obviously, we've had fiscal concerns, but bond market volatility has been muted. So that's my concern, is that if we get another recession at this point in time, driven by a financial downturn, that could be quite disruptive for bond markets.
Well, fascinating. Well, I think we're all referring back to the James Carville quote about coming back as as the bond market. It's the only thing that can really, I think,
Yes.
stoke fear in politicians and everyone else. And certainly so far, you're right. It has been muted. It has been exuding calm, which is perhaps translating into perhaps a unnatural calm across equity markets. We don't have time to discuss some of the other aspects, which I think are richly have a rich potential. And we talked about the K-shaped recovery, as well as the equity market concentration. Just a few additional comments on where we stand in 2026. Both of us are sitting in Europe. We do know that geopolitical instability, even though the focal point was Latin America this week, and we know that more broadly there's a lot of focus both on Greenland and on the Russian situation. So that is very much on Europe's doorstep. So I think more of that, probably addressed in part with defense spending in the year ahead. It's not just the US that has an AI encroaching upon jobs problem, and Europe has that to contend with. We talked about the dollar, and based on this, the uncertainty around Fed policy, the dollar has stabilized a little, and whether that will continue, or whether a divergence in rate direction will cause that to weaken. I think that has to be something that we look at for the for 2026. And then just a final word on some of the dynamics in European markets. You're sitting in Dublin, seeing a record tax take there of 106 billion euro in 2025, despite fears over tariffs. So not just the US economy that's been resilient. And then another evidence of resilience I've spoken about before is the London office market, which is another market that had been kind of written off and now been sort of shown to show signs of life. So just a final thought, Alan, on terms of your optimism index as you look to 2026. We've mentioned some of these, this was the risks that are afoot. How do you see some of these? Where do you fall on that optimism scale?
Definitely, I'm probably more on the cautious level. I'm probably naturally cautious. So, yeah, I'm more cautious than optimistic. But, as I say, we're not market timers in our business. But, certainly there's a lot of geopolitical risks. Valuations are high. The rally is intact for until it isn't, I suppose, is how we approach it. So, probably maybe a 6.5 or 7 in terms of optimism.
Well, thank you so much, Alan. This was, as I said, I think we only scratched the surface of some of that wonderful white paper that I can put a link to in the show notes, and we've captured some of the key graphics from that. Clearly, we are all thinking about the regime we're in and how our portfolios are right sized for that regime. I think we will continue to need to question the conventional wisdom as we see it, and continue to challenge some of the sound bites that the media is circulating, particularly as so many of them tend to converge to the same point of view. So thank you so much, Alan, for sharing your insights and joining us here.
Great. No, enjoyed it. Thanks very much for having me.